Alright, so we're going to start on chapter 7, which is accounts receivable, right? Up to this point, we've been dealing with accounts receivable. Remember, if you think back on chapter 5, right? You would remember that accounts receivable is when we provide a product or a service and we don't initially get cash, right? We give them credit terms and that and money comes at a later cycle. So up to this point, we have dealt with accounts receivable as a static issue, meaning that someone takes out credit and then they pay it back. Right? In this chapter, we'll be dealing with it in a more dynamic way. We will take into account that individuals don't pay and how do we do the accounting for that. When we do a credit sale, two of the major things we have to maintain is a separate account for each accounts receivable, and we also have to account for bad debt expense. So, for example, Barton Company sells $950 worth of merchandise to Webster and $1,000 worth of merchandise to Matrix. When that happens, we're going to debit accounts receivable, and credit the sale for each of those accounts. And we're going to denote each of the individual accounts because what we'll be running in the background is a subsidiary ledger which accounts for how much each individual company owes our company. Everyone with me? And why we're going to do that is because we want to know exactly how much each client owes. So if later on, let's say on July 31st, Webster comes back and pays $500 and Matrix pays $800, we're going to debit the cash account and credit each of their individual accounts receivable. And what will happen is we're running a tally, I'm sorry. Whoops. So if you see here, they purchased $950 worth of material or merchandise on July 16th. On July 31st, they paid $500, so they owe $450. They have $450 left on their bill for their credit line. Matrix bought $1,000 worth of material on July 16th. On July 31st, they paid $800, so they owe $200. Everyone understand? It's pretty straightforward. It's not. Nothing in this chapter will be complicated. Most of it in its entirety is very straightforward. All right, credit sales. Credit sales are, most people think of your credit cards when we talk about credit sales, but the advantages of having them is customers are evaluated by their credit card issuers, right? And you get a FICO credit score for it. Right. It increases sales, right? The risks of extending credit are transferred to the credit card issuer and not the company that's doing it. And cash collections. Most of your credit card companies in the investment world are considered to be technology companies. They're technology companies, right? Visa, MasterCard, and the like. The loan or the line of credit that you're getting, let's say for instance you have a Kohl's card. If the Kohl's is not extending you a line of credit if you have a Kohl's credit card, there's normally a financial institution behind it that is extending this line of credit, namely someone like Wells Fargo. So if you have a Kohl's credit card, what is happening is Wells Fargo has a agreement with Kohl's to utilize their brand and to extend credit to their customers. But you owe Wells Fargo when when you use the credit card, you don't owe Kohl's. Everyone with me? You with me or you not? Right, so you think of, if anybody's working retail, sometimes at the end of the night you run a tape, right, on the credit card machine. What the machine is saying is, hey, Wells Fargo, you owe Kohl's, let's say $10,000. And then Kohl's pays the $10,000. And then when you get that bill with the Kohl's name on it, when you're paying it, you're not paying Kohl's, you're just paying Wells Fargo that for the money that they gave Kohl's. Everyone with me? So when you have these credit card sales, you're going to have a charge associated with it, right? A service fee that the company pays. So like in this example, Barton Company has a bank credit card sale of $500 to a customer. The bank charges a processing fee of 2%. How that transaction works, you're going to debit 2% of $500 is $10. So you're going to debit your cash, $490. You're going to debit the credit card expense, $10, and your credit the sale for $500. You notice, although they ran their credit card, they're calculating this as a cash transaction because it is the financial institution that is got the long view. They'll get the money from the financial institution within a day. Everybody with me? So for the company that sold the merchandise, that's a cash transaction for them. It's not a accounts receivable. Now, here's another example. Let's say, for instance, there is a delay in payment, right? So same situation. The Barton Company bought $500, had a customer buy $500 worth of material. 2% is their credit card charge. However, they have to wait for payment until July 28th. With that delay in payment, we're no longer going to classify this transaction as a cash transaction, but accounts receivable transaction. It'll look like that. Debit accounts receivable to the credit card company, right? Not to the client. The credit card company will have accounts receivable for that individual client. You will have a credit card accounts receivable for the credit card company. Debit the credit card expense, credit the sale. And then when the credit card company pays you, you debit your cash and credit the accounts receivable for the credit card company. Everyone with me? Next, the next topic in this chapter is valuing accounts receivable. Basically, it's dealing with bad debt expense. As I stated before, we've been dealing with accounts receivable in one static way. People purchase goods on credit when people pay. But do people always pay? Do they? No, right? Sometimes people do not pay. So we have to account for that lack of payment, and the way we do it is bad debt expense. There's two ways we can account for bad debt expense. One way is the direct write-off method. The second way is the allowance method. The direct write-off method is very simple. It's the simplest of all. It's one of the simplest methods. Okay? So on August 4th, Barton determines they cannot collect $350 from Martin, who was a credit customer. What will they do? They're going to debit their bad debt expense and credit the allowance for the credit for the accounts receivable for Martin. And that's writing off the account. That's it. When they find out they cannot collect, they will write off the account. They will debit their bad debt expense, credit their accounts receivable. Now, what happens if, let's say, Martin comes back later and pays at least a portion of their bad debt? Well, the first thing that we'll do, we will reconstitute the account. Reconstitute the account. And how we do that, we flip the prior transaction. So remember the prior transaction when we wrote off the debt was a debit to bad debt expense and a credit to accounts receivable. Now we're going to flip it and we're going to debit accounts receivable debit accounts receivable, credit bad debt expense. The reason we do that is to show people who come back later, the auditors and everything, that hey, this person came back to pay off this debt. So we'll reconstitute the account first, then we'll debit cash, credit accounts receivable for their payment. That's if they come back and pay. Questions? This is very simple. So when an individual comes and says they owe the money, we'll debit bad debt. The individual comes and says they can't pay, we'll debit bad debt expense, credit their accounts receivable for what they cannot pay. And then if later on they come back and they do pay, we'll reconstitute their account by debiting accounts receivable, crediting bad debt expense, and then we'll take their cash, debit their cash, credit their accounts receivable. That's it. That's all you're going to do for direct method. Now the problem with the direct method is twofold. One, there's some materiality constraints. It states that an amount can be ignored if its effects on the financial statements is unimportant, right? The other thing is there's a matching issue, right? A lot of times we're trying to put expenses and revenue in the same accounting period as best as we can. And what you'll have with the bad debt direct write-off method, is that you'll have individuals that with the direct write-off method that have a sale or revenue in one period and an expense in another period. Everybody with me? So think of when a company or individual purchases lighting power, right? They might have a power bill that they've generated in December. They lit their house up with all the Santa Clauses and the Grinch, and the Grinch chasing down the Santa Claus, and angels coming down because the baby Jesus saved Santa from the Grinch. You know the Christmas story, right? So they'll have this whole story lit up on their front porch, right? And let's say they get their meter checked on January 1st, and they'll get a bill on January 15th that says they owe $1,000 for lighting. Everyone with me so far? So do they have to pay on January 15th? No, it'll normally say, here's your invoice, it's owed on February 1st. So let's say February 1st, our joyous Christmas guy doesn't pay his bill. Maybe he had too much on his credit card bill from his purchases during Christmas, right? He bought too many lights and too many blow up dolls and all that, and he doesn't have the money for the bill. So he doesn't pay. What happens? What happens is Dominion Power gives them a first notice, right? If you don't pay by March 1st, we're going to cut you off. Right? And let's say March 1st comes and our individual says, you know what? St. Patrick's Day is right around the corner. March Madness. I'm feeling festive. I'm going to throw me 2 parties. Forget paying that bill. I'm going to use the $1,000 to bring happiness to the Irish and basketball fanatics. They didn't pay the bill. What happens? Huh? No, not yet. Can't legally just shut them off one notice. Got to give them what? You get a second notice, right? Say, hey, you didn't pay your bill. You owe us for December, January, February. You got to pay. Now it's April. let's say our friendly neighborhood guy is feeling a little spiritual. Come April, Easter's around the corner. He's been observing Lent. He says, you know what? I'm going to give my money that I was going to give to Minion because I was going to pay my bill. I'm going to give it to Jesus. So Jesus deserves it, right? So he tithes. That's his thing for Lent. He's going to take all his money he was going to give to the bills, and he gives it to the church. So what does the company have to do? They give him the final notice. The third notice is your final notice. You don't pay this time, I'm going to cut you off. I'm serious this time. Not playing around. He doesn't pay in May, and what happens? No lights for Mother's Day. He's a bad dad, bad husband. All right. Celebrate Mother's Day in the dark. No. All right, so in May, Dominion Power says what? It's bad debt. It's now bad debt. We know it's bad debt. He's not going to pay. The guy, we saw him on Instagram. He's having a great time. He's not going to pay. Right? He was partying in March. He was in the church in April. I don't think he's came out of that church. He gave all his money to the church. So not going to pay. So what are we going to do? Well, we're going to write it off. But if we debit the bad debt expense in May, and we had credited the revenue account back in December, what we actually have is something that's not, the matching expense is not observing. Because we have an overstatement of revenue in December and an overstatement of expenses in May. And that's not good. Because we want to try to put our expenses and our revenue in the same period as best as possible. Best as reasonably possible. So, what do? How do we correct this? Well, we have the allowance method. With the allowance method, what we're going to do is at the end of each period, we're going to set aside some money, an estimated bad debt. And we're going to say, okay, this money is set aside, so now every time we have bad debt, we're not going to expense it off the income statement. We're going to take it out of this pot of money that we've set aside. Everyone understand? Do you understand? Understand? Say yes. Yes. Okay, I think a lot of head nodding, but that'll work. All right, so there are two advantages to this. One, it records the estimated bad debt expense in the period when related sales are recorded. Secondly, it reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. So here's an example. At the end of the first year operation, Barton Company estimates that $3,000 of its accounts receivable will prove uncollectible. The accounts receivable balance of December 31st, 2013 is $278,000. What do? We debit bad debt expense, credit allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account. It is contra to the accounts receivable. So we go to the next slide. We see a partial balance sheet where we have cash, accounts receivable, less the allowance for doubtful accounts. So it's the accounts receivable minus the allowance for doubtful accounts will give you $275,000, which that's the carrying balance. Go ahead. That's fine. Everybody with me? Estimates are easy. Estimates will be, estimates come through one of three methods. One, historical data. What the company does, they go back in their data and say, hey, this has historically been the amount of accounts receivable that we normally, that comes up bad. So this is our estimate for the future, present and the future. Two is industry industry data or industry standards, right? They'll look at their competitors. They'll say their competitors are normally bad debt expense is 1%. So we'll estimate that our bad debt expense is 1%. And then third is some hybrid of both 1 and 2. Everyone with me? All right. So for this course though, for intro to accounting, that estimate will be given to you. Everyone with me? Good. Now, there are two methods. There are two major methods that we do to calculate bad debt on the allowance side, allowance method side. One is percent of sales. The other is percent of accounts receivable. Right? So percent of sales and percent of accounts receivable, both are very simple. Everybody with me? They are both very simple. Okay? So percent of sales, let's say Barton has credit sales of 1.4 million, right? Management estimates 0.5% of those credit sales will eventually prove uncollectible. What you will do, you will take the sales, times it by the amount that's the percent that's uncollectible. So you take the 1.4 million, times it by 0.5%, you get $7,000. Then you will debit bad debt expense, credit allowance for doubtful accounts for that $7,000. That's it. Everyone with me? The other method, the percent of sales percent of accounts receivable method, same basic, the starting technique is the same, except for here we're going to deal with accounts receivable instead of sales. So Barton has $100,000 accounts receivable, existing $900 credit balance, and allowance for doubtful accounts on December 31st, 2013. Past experience suggests that 4% of the receivables are uncollectible. So how do we find bad debt expense? Well, first things first, we'll take the accounts receivable, which is $100,000, times it by the 4%, which will give you $4,000. Everyone with me? Now here's where things change, scholars. The difference between this and percent of sales, and please keep this in mind for your midterm coming up, is that in this case, this is what we want to see as the ending balance. So we don't jump straight into doing the journal transaction. We have to recognize that this is what we want to see as an ending balance. And so the next step is to figure out what the beginning balance for this account was. For this account, it was $900. So because we start off with $900 and we want to have the account to have $4,000, we're not just going to debit bad debt expense and credit allowance for doubtful accounts for $4,000, like if it was percent of sales. What we're going to do is debit bad debt expense and credit allowance for doubtful accounts for the difference between the beginning and the ending balance. And that will be $3,100. Does everyone understand?
Can you please explain why you put it as ending balance and not the regular allowance?
What they're doing here in accounts receivable, they're saying what we want to carry every year is $4,000. In percent of sales, they're just saying, hey, we're going to set aside $4,000. We don't care. Everybody with me? So, yeah, the illustration. Alright. So if you were thinking of sales and you're thinking of accounts receivable, right? So let's say in 2018, we set aside 4,000. We'll do the same thing for each one, right? So 4,000 for each, right? And then, so at the beginning of the year, we set aside 4,000. At the end of the year, we use, let's say 2,000 each, right? Here we'd have an ending balance of 2,000, and here we'd have an ending balance of 2,000. Oops. Everyone with me so far? So the next year, so 2019, right? We want to reconstitute the allowance for doubtful accounts. We're going to do $4,000 again. For sales, they're just going to set aside another $4,000, and they'll have $6,000 in the account. But for accounts receivable, they want their ending balance to be $4,000. So they're only going to add $2,000 to the account. Everyone see that? To get $4,000. So let's say in this year, at the end, let's say they use $6,000. Everybody with me? So here, they use $6,000. They use $6,000, they have nothing left in the account. Here, they use $6,000. They've overused, extended their account by $2,000. So 2020, they want to bring $4,000 for sales. Remember, all they're going to do is just add the $4,000. So they're just going to add $4,000 again to the account to bring it to $4,000. Simple. You're just constantly going to just put $4,000. Well, for accounts receivable, they want their account to be $4,000. So now, how much do they need to add? They got to add 6. Everybody with me? Now let me show you another trick. Let's say 20, 21, they added, let's say this year, the 2020, they use, let's say $2,000 again. 2,000 here, use 2,000 here. And then they add another 4 here at the end of 2,000. Did I do that right? And another 4 to get them 6,000 here. Let's say here, remember they're just trying to get $4,000, so they're just going to add 2,000. Here's where having an excellent accountant can help. Let's say while this is going on, let's say this is 2021. The company misses its, let's say, at the end of 2021, they use $2,000 again. So they have 2,000 here and 4,000 here, right? And this is I'm going to show you why a lot of companies use sales. Let's say they miss their numbers. The company misses their profit number, right? Let's say they miss their numbers by $3,000. What can the company do? So reflect on this. This is a debit to bad debt expense. So does it work inversely, or does it work in tandem with profits? Meaning, do profits go up when expenses go up, or do profits go down when expenses go up? Profits go down when expenses go up, right? So when you're adding this expense, what is it doing to your profits? Bringing them down. Everyone with me so far? Now this is a book transaction. There's no cash here. Does that make sense? When we're saying we're putting this money to the side, is there actual cash going to the side? No. Because it's not against the cash balance. It's against the books. So we want to be profitable in a book sense. We're talking about the books. But let's say you missed your mark by $3,000. What can you do as an accountant to get the company profitable? A little bit. It's even a little deeper than that. What you can do?
You move it to the liability.
No. We're gonna do something more legal than that. that will fly against GAAP and accounting laws, right? So what we're going to do is lower the amount that we take aside. Because remember, these are estimates. They're not set in stone. You don't have to do $4,000 a year. Everyone with me? So let's say this year, instead of us doing $4,000 a year, here we are, 2021. We're like, no, we're only going to take $1,000 back. Okay? Not only are we going to take $1,000 back, we're going to say to the company, or the board of directors will say, look, this $4,000 we got set aside is too much. Because our competitors have $2,000. Someone else has $2,000. So we're going to bring back $2,000 of this, and then we're no longer going to set aside $4,000. We're going to set aside only $1,000. Maybe we justify by saying our clients have better credit worthiness than they did in the past, right? When I say they have better credit worthiness, how would you explain that to your grandmother? You say what? They're more what? You would tell your grandma that they're more reliable. Huh? Oh, I thought sure you just said FICO score. I was like, you would tell your grandma they had a higher FICO score? What would you say? More reliable?
There's more chance of them paying. They'll pay. Most probably they'll pay.
Probably. Your grandma. You say probable. Your grandma would definitely know you went to college. She would say what? What would you tell your grandmother?
They pay.
They pay. Yeah. Yeah, they're gonna pay.
They're nice people.
They're gonna pay. They're nice people. Yeah, I guess you would say that to your grandmother, right? They're nice people. They're gonna pay, right? That's what she would think. That sounds like grandma talk, right? Why'd they pay? Because they're nice. Oh. Right? So they'll pay, right? So, but what you'll go to the board with, you'll say, look, they have lower risk, which means that we have found that they have higher credit worthiness. With that high credit worthiness, right? We don't have to have such a high allowance for that bad debt. We don't have to set aside so much money. And you can justify this by saying what? We never went into the negative as far as our allowance for doubtful accounts. Isn't that true? We never went in the negative. So you say, well, we don't need to set aside all that money. So now, we're going to take $3,000 out. No, I'm sorry, $2,000, because we want to match our competitor. Right? So when we take $2,000 out, what's the journal transaction? Debit allowance for doubtful accounts. And credit what? Credit your bad debt expense. What have we done here? What is a credit to a bad debt expense? Scholars? One word. What's a credit to bad debt expense? And one word is a what? Revenue. Fantastic. Revenue. Think about it like this. Revenue. So now we brought this $2,000, and then our normal transaction would have been a debit to bad debt expense for $4,000, and a credit for allowance for doubtful accounts for $4,000. But now we're only going to hit it for $1,000. Here plus the 1,000 will give you 5. Oh, I'm sorry. 4,000 minus the 2,000 that we took out here, add another 1,000, and we're going to end up with 3,000 in the pot. But here's what just happened. This $2,000 plus the budgeted bad debt expense was 4. We'll reduce it to 1, so that added another 3. Does everybody get that? The budgeted bad debt expense was $4,000. Here, right? But we only took this year 1. So we saved the company how many? 3,000. Plus we reduced how much we set aside by 2,000. So that'll give you how much? 2 plus the 3 is what? 5,000. So now we added another 5,000 in revenue. So to go back to my scenario, if we missed profits by $3,000, now I added another 5,000 in revenue. Now we're profitable by 2,000. Just by managing the accounting. Everyone understand that? And this happens periodically, especially with the banks, because the financial institutions have large bad debt expenses, and every now and then they'll go and they'll restructure their allowance for doubtful accounts on the amount of money they've set aside, and they'll realize a one-time gain, and they'll make their company profitable. Now, are they truly profitable? What say you, scholars? Would you say this company is truly profitable by what I did?
Yeah.
Why? No? Why? Huh? What do you say?
I mean, they had enough the money before, it was just in a different account, so they still dropped.
Did they have money? Was there cash connected to this?
No,
I want you to think that.
Don't we have like a positive net income?
You're going to have a positive net income. But how did you do that? I thought you were saying, darn it, he got us. How did you do that? You became positive. You get this positive net income through non-day-to-day activities. Through non-day-to-day activities. If McDonald's is losing money on selling hamburgers, but they are making a profit because they're selling a building, is that sustainable, them selling buildings? No. Eventually that will go away. What do they need to be profitable in? Burgers. Everybody with me? So this works, this thing will work once, or twice every now and then. But over the long term, you have to be profitable in the business you're in, your day-to-day operations, not these one-time gain things that you can do on the side. McDonald's will have stuff like they'll have stuff like currency trades, right? McDonald's franchisees in other countries will pay them in their currency of the country, and McDonald's will have to trade the currency back into US dollars, right? And sometimes they'll make money off the currency trade. Does everyone understand the concept? Nah, is that something good? Is that something that you want to see from McDonald's? No, not really. It's just something that they do. What you want to see, when it comes to Apple, what do you want to see as far as profitability? Their selling of iPhones and iPads. When it comes to McDonald's, you want to see them selling burgers and fries. When it comes to Lowe's, you want them seeing selling hardware. You don't want to see them selling ancillary things to make ends meet. That means that their mainstay of their what they do is unprofitable. Everyone with me? All right, last but not least with this, we're going to do aging. Aging looks like this, right? The method, each receivable is grouped into how long it has been due. And then each age group is multiplied by an estimated bad debt expense. And that estimated bad debt for each group is total. So it'll look like this. And we're breaking this out in age groups because not all bad debt is the same. Say this again. Not all bad debt is the same. Up to this point, if it was accounts receivable, we say, okay, we treated everybody the same. There's a 1% chance that you will not pay. But all bad debt is not the same. The people who are not past due yet are more than likely to pay than people over 90 days past due. Everyone with me? So we cannot treat all accounts receivable the same. So we have aging, which breaks it out into time periods. Those time periods either is not due, and we're saying that there's a 1% chance that people whose bills aren't due yet will not pay. There is a 3% chance that the individuals that are 1 to 30 days past due will not pay. 3% of them will not pay. 7% of those that are 31 to 60 days past due will not pay. 40% of those 61 to 90 days past due will not pay. And 60% of those that are over 90 days past due will not pay. Now this is kind of like a fake world because anything over 90 days past due, this should be like a 99%. Something like that. Yeah. Higher than 60. At any rate, and then you break your accounts receivable down in their dates, and then you multiply by the date to get your estimated uncollectible amount. Summarize the estimated collectible amount, and you'll get $5,320. Aging falls under the accounts receivable method. So this $5,320 is what you will want for the total. It's not what you're going to debit right now. It's what you want for the total. So the next step, just like all accounts receivable, we need to find out what we still have from the beginning balance. So we still have $900 in the beginning balance. We want it to be $5,320. That's the amount we are calculating. What's the difference between those two? It's $4,420. So we're going to debit bad debt expense, credit allowance for doubtful accounts for $4,420. Let me give you guys a shortcut when it comes to the it's still up there. When it comes to the allowance accounts receivable method. If it is a debit, if the balance is a debit before you get to your desired amount, you need to add it to your desired amount to get your journal transaction. If it is a credit, you need to subtract it from your desired amount to get your journal transaction. If it's a debit, you need to add it. If it's a credit, you need to subtract it. Does that make sense? That's a streamlined method. That's the allowance method. That's aging. And then, if someone comes and it comes up that a client can't pay their bill, Barton determines that Martin's $300 account cannot be paid. Now you're not going, under allowance method, you're not going to debit bad debt expense. You're going to debit the allowance for doubtful accounts and credit the accounts receivable. Everybody with me? We're not going into the expense account every time someone writes off now. We're going into the allowance account. And we discussed recovery. So I'm not going to do that again. We've done one recovery. Notes receivable. Notes receivable is, I believe, the last part of this chapter. The biggest thing I want you guys to know out of notes receivable is the interest computation. Principal times the rate times the time gives you the interest, right? That will be something covered in your homework. A shorthand for interest times rate times time that you will commonly see in accounting, finance, economics is called the PERT, P-R-T. Right? Principal, rate, time. PERT used to be this fantastic acronym for the hair, like shampoo and conditioner. That was groundbreaking in the 80s. But nowadays, people don't even know what PERT is. We're like, PERT, what is that? It's like, they did it before Head and Shoulders. Anybody know what Head and Shoulders was? No? Head and Shoulders? All right. Thank God they're still around. So, if you're computing maturity date and interest, right? You got a copier for $12,000, 9% note due in 90 days. What would you do? You would take the the 12,000 for the copier, times it by the rate, which is 9%. Remember, when you multiply these rates, it says 9%, but you multiply by what?
0.09.
Yes, 0.09. Times it by the date, it's 90 over 360 days, not 365. Make sure you put 360. And that'll give you the interest amount. This is your journal transaction. So I don't even know. I'm not worried about these. What's it? Oh, the ratio. Net sales over average accounts receivable is your ratio. Questions, comments, concerns?
The 50 points that you're going to give us, are you going to add that to the midterm or separately?
Oh, 50.
Remember last class your phone went off and you're like, oh,
Oh,
shoot.
yeah. Yeah, I'm gonna give you that in your class